Imagine a friend comes to you asking for a 10,000 rupee loan. They promise to pay you back 11,000 in 6 months. That is an easy 10% return, so you hand over the cash. 6 months pass. Your friend loses their job, the money is gone, and instead of making a 10% return, you lose everything. What you just experienced is known as credit risk or counterparty risk. It is the danger that the person on the other side of your deal simply fails to meet their financial obligation to you. Every financial transaction in the world sits on top of this exact vulnerability. Whether you are splitting a dinner bill or a global bank is issuing a multi-million-dollar corporate loan, someone is trusting the other side to pay up. If participants cannot accurately measure and manage this specific risk, they are effectively flying blind in a financial system that relies entirely on trust. Scale this up to the corporate world. Think of a textile manufacturer shipping 50 lakh rupees worth of fabric to a major clothing brand, agreeing to get paid in 90 days. Before those 90 days are up, the clothing brand declares bankruptcy. The textiles have already been shipped, the labor is paid for, but the invoice will never be cleared. Look at this balance sheet. A defaulted invoice leaves the manufacturer with nothing. Credit risk physically vaporizes value straight from a company's ledger. Counterparty failure rarely looks like a sudden, dramatic bankruptcy right out of the gate. Defaulting is the most obvious threat, but this danger takes 4 distinct forms. First is downgrade risk. The borrower is still making payments, but the market notices their finances are slipping. Their credit rating drops from AAA down to BB, pulling the value of their bonds down with it. Next is settlement risk. This is a terrifying timing mismatch in global trading. One side sends their currency across the world, but the other side fails to return the corresponding funds. Third is concentration risk. This happens when a lender pours a massive percentage of their available capital into a single sector, like real estate. If that specific industry crashes, the lender's entire portfolio goes down with it. Because of these hidden variations, investors and banks can lose millions on a deal, even if a counterparty never actually files for bankruptcy. To see what happens when the ultimate counterparty fails, we look at September 2008 and the collapse of the investment bank Lehman Brothers. Lehman sat on the other side of thousands of global contracts, derivatives, interest rate swaps, and complex debt obligations. When they went under, hundreds of billions of dollars in active deals became instantly worthless. With nobody sure who was exposed to the bad debt, trust vanished. Banks stopped lending to each other, global credit markets froze, and the stock market rapidly crashed. Unmanaged credit risk at the institutional level is a virulent contagion that can shatter the entire global economy. Because counterparty failure destroys economies, the modern financial system is meticulously engineered to contain it. The first layer is predictive defense, credit scoring, and due diligence. Lenders calculate the exact mathematical likelihood of a default before a single dollar ever moves. Next is physical defense, collateral. Lenders require borrowers to put up a tangible asset, like a house, which the bank can legally seize to recoup losses if payments stop. Then comes structural defense. Banks enforce strict credit limits and diversification, using mathematical caps to neutralize concentration risk. Finally, the insurance defense. Institutions use hedging instruments, like credit default swaps, to secure compensation if a primary counterparty goes under. These tools cannot cure the underlying human risk of a broken promise, but they form a layer of structural armor, preventing a single bad loan from escalating into a systemic contagion. Ultimately, finance requires 2 separate parties to place trust in one another. Because of that fact, credit risk can never be entirely eliminated. You can, however, adopt these institutional tools for your own life. When navigating everyday loans or investments, you can apply strict limits, scoring, and collateral to your personal decisions. By altering how you view the people and companies on the other side of your deals, you can stop a simple broken promise from becoming a personal financial catastrophe.